Welcome to episode 35 of the Alex Nunemaker Mortgage Podcast for the week of March 13th, 2023. In market news, man, where do we start? Well, I think the obvious choice is going to be Silicon Valley Bank and then First Republic Bank. It's got to be the obvious choice because that has started a domino effect that overall has been positive for mortgage rates. And the simple answer for this is that there's been a flight to safety for investors. Mortgage-backed securities are just a better investment vehicle right now. So as that demand has gone up, that's been good for mortgage rates. Then, in the middle of the week, amidst all of this, the European Central Bank hikes rates 50 basis points in the middle of a banking crisis, which has created some turmoil. But wow, is that interesting, because we've got a case study right here in the U.S. that we are seeing in real time of what can happen to the banking industry when central banks don't show enough patience and just keep hiking rates without being patient enough to fully realize their impact. The example that I've heard from Barry Habib, which I think is very accurate, is it's like a patient needing medicine. You give them a pill. No effect, but it takes an hour or two to start to work, but you're not patient enough, so you wait 5 minutes, you give them another pill. No effect, give them another pill, and then you overdose the patient. The central banks are acting recklessly, and if they're not careful, there could be more unintended consequences like this from hiking rates too high and too fast without understanding their consequences. For the time being, we'll take the lower rates, but this is a very volatile time right now. In the mortgage corner, let's talk about FHA, which I think is going to start to become a lot more attractive to buyers. And the reason behind this is going to be twofold. Yes, we know FHA reduced their monthly PMI, which is great. That makes their payments a lot more palatable. But the other side of this coin is conventional loans. They've started to implement loan level pricing adjustments. They're starting to go into effect right now. The official start date for these adjustments is May 1st, but keep in mind, May 1st is the deadline for when the loan actually gets sold to Fannie Mae or Freddie Mac. So a loan might be closing before then, but it doesn't get sold to them until much later. So that's why these adjustments are going to affect now. As a reminder, these adjustments or fees are pass downs from Fannie Mae and Freddie Mac. And on this video, I've shown a heat map. This shows which loan to values are going to be really impacted, but pay attention to the sections in red. So if you actually look at this video, I've shown a map here. What is interesting is how they are punishing well-qualified borrowers. Look at the column with clients with a credit score between 720 to 759 who are putting 15% down. That adjustment of 0.75% means that after these adjustments went into place, assuming there's no other market movements, that same client now has to pay 0.75% to get the same interest rate. These are well-qualified clients who are getting stuck with a huge adjustment. Why would they? Now, what's also really interesting is who is not getting hit, but actually getting a pricing improvement. Look at the lower credit tier borrowers, like around 620, 640 credit score clients. They usually are not going to be the person who traditionally has utilized a conventional loan because the pricing is just not that great. Their pricing got better by a whopping 1.75 to 2 whole points. So, don't be surprised to see a big shift in home buyers' preferences. FHA is going to start to make a comeback, and this is the big reason why. In honor of St. Patrick's Day, let's have an Irish blessing as our quote. May your troubles be less, your blessings be more, and nothing but happiness come through your door. Have a great week, and if I can help you or any of your clients with any questions or pre-approvals, let me know. They can visit me at homeloanswithalex.com. Have a great week.